Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. The conversion, at least for the time being, of the November 21 to May 2022 head and shoulders top to a head and shoulders continuation pattern, and now possibly back to a topping action, has no doubt been the schizophrenic event of the year here in this market. It's also been the event that has led to another much larger pattern. So, early June saw the market reach up to the 2012 high at 241.05, creating an unsuccessful, smaller reverse head and shoulders pattern for the mid-April, end of May action, with retired targets. We've seen since that height in June so many contrary and conflicting patterns here, but we seem to have settled into a set of two steps down and one step up action until last week, or rather until late the week before, when we had a bearish strategic event, a bearish bow tie formation of the short moving average, currently 218.20, the medium moving average, currently 223.25, and the long moving average, currently 225.95, crossing over each other and crossing outwards again. That, I suspect, triggered last Monday and last week's move lower. Prices closed below both the 50% Fibonacci on the August 21 to February 2022 move at 217.45 and the lower trend line, currently 215.35, of the bigger pattern, or at least I thought it might be the lower trend line of the November 2021 to date, that is, lopsided diamond pattern. Now, I thought this trend line, which was the April, say, 2021 to date uptrend back then, might be the lower uptrend trend line of this lopsided diamond pattern. However, looking at the reassigned uptrend today, currently at 194.70, well, this also might be the lower uptrend of the diamond pattern. Additionally, it might all look like a bear channel as well. Boy, it is not easy, that's for sure. Anyway, a more near-term pattern has been the lopsided cat's ears pattern over late May to date. This pattern is a derivation of a double top pattern, though the right ear is significantly lower than the left, and we have what appears to be a third ear as well. But elements of this pattern still do exist. Hence, I had placed previously potential primary target X2 for the cat's ears pattern in the 201 even area, as well as a secondary target X3 in the 196 even area. Despite my skepticism about this pattern, last week proved to be a fantastic advertisement for this cat's ears, or cat's ears generally, as both targets X2 and X3 were both reached on the same day, last Thursday, and by last Friday, the market had reverted back up again in a very satisfying way, but only as far as the original lower trend line of the diamond pattern. You can see now how it is all complicated and interconnected. Anyway, there is just the bow tie formation of 3 moving average to talk about. It's not a perfect bow tie, but the moving averages are in the right order and it is still there. Now, in bow tie formations, there are two expectations. The first is that between 15 to 20 sessions after the crossover, we should see a move in the direction of the bow tie. This will be between the 29th of July and 5th of August. Secondly, that the market will move in the direction of the second bow. That is the one after the crossover. Hence, this looks like a bearish crossover of moving averages. It now depends on what happens at the turn of the month. London coffee futures. As I keep saying each week here, mainly because it still resonates to this day, is that the key difference here seen in London compared to the New York contract is how the peak of the market was back in late December 2021, rather than when New York had it, which was in early February 2022. This difference has been crucial to the formation of a pattern here in the London contract, much earlier compared to the New York contract. We had a November 2021 to February 22 head and shoulders top. Admittedly, the first shoulder is split, but the action nevertheless stacks up as a legitimate pattern. The neckline, currently at 21.02, is super important, as it resonated recently as 4 weeks ago when prices moved up to touch it and almost immediately backed off down, going back down. Now, let's go back a bit to what happened in March. The market broke down through the neckline, but ended up until recently unable to penetrate the support area underneath that stretched from the 2004 level all the way down to the 1935 area. In early May, prices made a significant attempt lower, making a new low at the time, not seen since August 2021. The key takeaway from this was how this head and shoulders pattern was a topping action, thus completely different to what we've seen in the New York contract. Since that attempt lower back in early May, we've seen the market start to develop not only intraday indecision, such as spinning tops, but also intraday indecision with contrary patterns one after another. This indecision overall worked the market lower, that at the end of June prices had finally reached the 2004 level and started tackling it, and the other supports initially all the way down to the 1968 area. However, last week prices accelerated their decline, breaking down through the 1935 area. And this brings me to the large pattern I've been commenting upon now for weeks. It is a large rectangle pattern originating from the start of March until the end of June. Now, I call it a rectangle, but it is moving to more like a shallow descending wedge pattern. But for now, rectangle will do. That's currently between 2000 even and 2136. The primary target X for this pattern on the downside was in the 1923 area, with secondary harder to get target X1 in the 1858 area. Last Friday, the market moved down and reached the primary target area. Today, somewhat satisfactorily, I have to add, the market has turned back up with a long white Mariposa, thus creating the chance for a 3-day bullish morning star pattern, which includes today. So target X has been achieved. It now depends if the market has the appetite for target X1 in the 1858 area. Right now the answer is no, and not just a simple no caused by today's big move up. You see, the last 3 days since last Thursday have created a 3-day bullish morning star pattern, a significant piece of work. Yet even this has now become caught in the resistance formed from the low trend line on the recent rectangle pattern stroke shallow descending wedge pattern, and so that's currently at 2000 even. It now very much depends on what and where the market does and its closes around that key number, and to decide what will be next. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.